All right, welcome to The Explainer. Today, we're jumping into something that's, a huge deal for how everything gets from point A to point B around the world. We're talking about the engine of global trade. But here's the crazy part. For years, this super important idea was dangerously, undefined.
I mean, just think about that for a second. What if a core pillar of how our entire global economy works just didn't have a single agreed-upon definition? No one rule book that everyone could point to. It sounds pretty chaotic, doesn't it?
Well, this isn't some hypothetical scenario. For the longest time, this was the reality for what we call trade finance. And that lack of a common language, that wasn't just some academic problem. It created genuine confusion and led to what the International Chamber of Commerce themselves call unintended negative consequences for real businesses, big and small. So here's what we're going to do in this explainer. We'll look at the dilemma, check out the new official definition from the ICC, break down its key ingredients, figure out what's in and what's out, and finally, get to the bottom of why all this clarity is so crucial.
Okay, so first up, the definition dilemma. Because really, to get why the new definition is such a game changer, you first have to understand the problem it was designed to fix.
The main problem was basically a free-for-all. There was no single agreed-upon definition of trade finance for regulators around the world to use. This led to some really misleading, oversimplified ideas, and it created a ton of confusion about what's even included. I mean, how are businesses supposed to play by the rules if the rules keep changing depending on who you talk to?
And that's where the solution comes in. The International Chamber of Commerce, or the ICC, saw this huge gap and stepped up to the plate to create a single, clear, global standard.
And here it is, the official definition from the ICC, fresh for 2024. Now, I'm going to read this out because every word is important. Trade finance is a financial service facilitating the real economy, enabling businesses to finance, monetize, risk mitigate, and settle trade flows, thus supporting the movement of goods and/or the performance of services regardless of maturity, both internationally and domestically. Now, for me, the most powerful part of that whole thing is the phrase, facilitating the real economy. That right there is the key. It anchors everything in the real world, actual goods moving, actual services being performed.
And the goal here was simple. Make a definition that's straightforward, short, and easy for pretty much anyone to get. They purposely stayed away from super complex jargon. Why? So that a regulator in one country and a small business owner in another could both look at it and know exactly what it means. It's all about being accessible.
All right, so now that we have the official definition, let's kind of pull it apart and look at the key ingredients that make it up.
Okay, so at the very core of any trade finance deal, you've always got three main players. First, you have the seller. This is the person or company exporting goods or providing a service. Then, you've got the buyer, the one importing those goods or getting that service. And finally, you have the financial institution, like a bank that kind of sits in the middle providing the money or lowering the risk for everyone involved.
Now, beyond just the players, there are two other really important parts. The first is the transaction itself. It has to be connected to a real, specific flow of goods or services. It can't just be a random loan. And second, its purpose is always a double whammy. One, to provide the financing for the trade, and two, to manage the risks and help the buyer and seller settle up safely.
This leads us right into a super important point, clearing up what actually counts as trade finance and what doesn't.
So let's get specific. What's in? Well, it can be domestic trade or cross-border trade. It can be short-term financing or long-term. Even guarantees are included, as long as they're tied to a trade. But here's what's not a defining factor, and this is where some myths get busted. Things like how long the financing is for, the tenor, or the final maturity date, those don't matter. The destination of the goods doesn't matter either. The only thing that makes it trade finance is that link to a real transaction.
Let's zoom in on guarantees for a second. A guarantee only gets to be called a trade finance instrument if the deal behind it involves actual goods moving or a service being performed. The new definition is really clear that it doesn't include things that are basically just loans dressed up to look different, what they call credit substitutes. And you can bet that distinction is a huge deal for regulators.
Okay, so let's bring this all together. We've gone through all the details, but why does this matter? Why is having one single, clear definition so incredibly crucial?
Well, it really comes down to the power of having just one single, clear definition for global trade. When everyone, regulators, banks, businesses, is on the same page, it just works. It gets rid of the confusion, it lowers the risk, and it creates a level playing field for everyone, everywhere.
And this takes us right back to that key phrase we talked about earlier. A clear definition helps facilitate the real economy. You know, it's not just numbers on a screen. This is what helps make sure that the stuff we use every day actually gets made and moves around the world. It's about a real-world impact that you can actually see and touch.
So, let's do a quick recap. For a long time, trade finance didn't have one single definition, and that caused a lot of confusion. The ICC has now defined it as a service that finances and protects real trade transactions. Remember, it always involves a seller, a buyer, and a financial institution. And its validity doesn't hinge on things like the length of the financing. What matters is the link to real goods and services. And having this clarity is what helps keep the whole global economy ticking along.
So, that leaves us with one final question to chew on. If this new definition is like the perfect map for global trade, then whose job is it to make sure everyone is actually using that map correctly?
What do you think? Who's responsible for making sure everyone adopts this? Drop your thoughts in the comments below. We genuinely love to see what you think. Thanks so much for watching this explainer. If you got something out of it, a like would be awesome. And be sure to subscribe for more deep dives just like this one.